help me welcome up Mike Reed, who is the Vice President and Head of Digital Asset Partnerships at Franklin Templeton. He is involved in seeking partnerships across the ecosystem, both with digital asset companies and with digital native payments. Jesse Cow, who's a finance expert and entrepreneur, he is currently the VP and Head of Finance at Gauntlet Network. And that is a financial modeling platform that uses algo trading industry information and techniques for on-chain protocol management. And Erbil Karaman, a highly skilled product expert. He's the CEO of Huma Finance, a DeFi platform that allows you to finance any receivable on-chain through liquidity pools. And prior to that, he was the head of product and consumer platforms at Lyft. And it's hosted by Bitwave's own Chief Strategy Officer, Devin Eldridge. Take it away, guys.
Awesome. Thank you, Amy. Well, I'm personally excited about this. It's something we talk a lot about at Bitwave and see customers adopting the future of what Treasury looks like for the enterprise. So really excited to have everybody on the panel and talk about some of these new tools, products that are available that people can be using and get some advice from some experts. So, the, I guess, 100-year-old elephant in the room, Franklin Templeton has been around for longer than anybody in this room and continues to innovate. So I wanted Mike just to take a little time. You're doing a lot of stuff exciting on-chain, a lot of people might not know about here. Can you describe some of maybe like the staking activity and your on-chain money market fund?
Yeah, sure, thanks. By the way, I think I lead the panel on disappointing photos. It was a long time ago. So hi everyone, I'm Mike Reed. I lead strategic partnerships at Franklin. We've been in the space for several years now, kind of behind the scenes doing a lot of different things and building things out. Something we're super excited about, we put a press release out yesterday, is our Benji token. What Benji is Benji is a way for you to own a money fund in digital form. So we have this fund called the Franklin On-Chain U.S. Government Money Fund. You can buy that fund and transact in it in Benji tokens. One Benji token is equivalent to one share of the Franklin On-Chain U.S. Government Money Fund. This isn't a sales pitch, I'm just talking about something we did. And it's pretty interesting. It was this whole thought exercise initially when we started talking about it to try and figure out a way to stress the tech. And quite frankly, money funds have long been involved in the transactional economy. So there's a lot of transactions that take place. In our product, there's daily accrual of interest, so there's all that happening, and payouts and things like that. So we started with a money fund in particular because of that. We wanted to be able to see what we could do in putting a public asset on chain and do something that was going to be transaction intensive. So we picked this money fund and we did it, and we launched publicly on the App Store last year, and then, like I said, put a press release out about it on Monday. So that's one big initiative we did. Also, just as a heads up, we built all that tech in-house. We have a digital wallet infrastructure, a digital TA. We did all of that in-house. So that's one thing we're doing. Another thing we're doing, we have a group that manages multi-coin portfolios that we distribute in SMA form using the Eaglebrook platform, which is a turnkey asset management provider for RIAs. So people can buy multi-coin strategies that we offer in the form of model portfolios. We also have a group that's running multiple nodes on multiple blockchains. So we're doing a lot of really interesting things in the space. And like I said, we've been building for a while, and we're super excited to be here at Consensus to be able, or EDAS, but then Consensus, to be able to kind of come out and explain everything that we're doing. Our CEO is actually going to be a speaker tomorrow, I think. So anyway, thanks for having us.
Yeah, of course. Yeah, I was pretty fascinated when you told me kind of everything Franklin was doing, and it was a little bit incredulous maybe to start, but it's been pretty impressive to continue to see that. And with Franklin, internally, you have all these nodes running on different networks. What are you doing with all these assets? What's kind of like the Treasury process there? Are you guys kind of sitting on those? Give us a little bit of peek behind the scenes there.
Sure. Well, I mean, relative to our large overall corporate balance sheet, obviously the amounts are not that large, but really, those are conversations that have to take place. You have to talk to somebody who's only been involved in traditional finance and start to explain what digital assets are and how they work and things and how we should think about them. So, we operate our Benji token on Stellar. So Stellar has lumens. You have to think about all of that stuff. And a credit to our C-suite. They actually were super excited about getting involved in the space and super supportive. So it wasn't that big of a lift for us in terms of education, but certainly we think about these things, of course.
That's great. And Erbil and Jesse, what do you guys think? Are we at a stage where in 2023 we're suggesting, we kind of saw a wave with like Bitcoin on balance sheet. Of course, if Michael Saylor is on stage, we'd be saying yes, crank it all into Bitcoin. But are enterprises ready, to have digital assets on their balance sheet and manage that?
Well, first I think I need to get those Benjis that Mike was talking about. But I think it depends on where you are, at what stage you are in your life cycle as a company. If you're ready to make, investments, outside of just holding like treasuries and whatnot. If you are ready for that, then yes, I do think we're at a stage where we're ready to purchase, Bitcoin or Ethereum. I think it was Bitwise that said, even like 5% in Bitcoin or Ethereum could help, diversify your portfolio and improves your risk-adjusted rate of return. So, yes, I do think we're ready.
Maybe just to add on to that, it probably depends on what kind of enterprise you are. There is like two sides of the equilibrium. One is like the enterprises that has nothing to do with crypto and no assets digital, at least not digital on blockchain because everything is digital. And then there are enterprises on the other spectrum, right, where everything is in a treasury, but it's fully on blockchain. You may be a DAO, you may be a protocol, Web3 organization that's getting paid in crypto. And I think for that end of the spectrum, it's already happening. And what these kind of solutions provide is like diversification other than just Ethereum and Rep Bitcoin and a few other assets that seem to have at least pretty much price alignment and similar volatility structures. So if you can actually add something that's less volatile to that mix, it's a great investment. So I think for that reason, it's wonderful for enterprises. But for the ones on the very other end, it might not be there yet. At least we haven't seen a lot of parties who are very excited about. But I think there's also the hybrids in between where they have treasuries and they have some activities that are getting paid in crypto assets. It's much better to keep your crypto assets, I think, on blockchain and just utilize it there versus like trying to pull them into fiat and use the bank infrastructure. It gives you also some opportunity to maybe avoid another crisis and be left out without any cash flow.
Yeah.
Sorry, can I?
Go ahead, Mike.
No, if there's a format, I don't mean to break it. Okay. I think that this thing you're talking about is suitability, right? Like risk tolerance, which is something in like traditional finance people have been talking about for forever. But I think in this space, it's particularly different because a lot of groups will have the vast majority of their treasury in their native token. So then, like, if you do a big fundraise and you have all these tokens, they're sitting there and they're worth $100 million, say, and you say, okay, $100 million, we got 4 years of runway with that token. And then the market craters on you, and all of a sudden you've got 25 million, and you have 4 years of dev work to do in 1 year, it just doesn't work. And so that thing about like diversification, risk tolerance, all those kind of like old world themes are really starting to kind of creep into our space where, people are like, maybe I need to diversify, find something, the volatility thing, right? Like you got to kind of hamper that a little bit and be smart about it.
Yeah, it just changes the timing of that planning, right? And that's what, actually, Jesse, you guys do that a lot at Gauntlet, right? So can you explain a little bit about, how you guys do that, help the token, based companies kind of foresee the future and how to plan for it?
Yeah, so, at Gauntlet specifically, I guess, for any company, it kind of just boils down to actually what your expenses are in. If you pay your employees and vendors in ETH, then yeah, you need to solve for ETH. But for us and for most companies, it's cash, it's USD. And so at Gauntlet specifically, what we try to do is we try to at least map out 18 months of runway for cash and cash equivalents. 3 months of that needs to be like, on hand, in your checking account. The rest can be in like a money market, type of fund where you have a lot of liquidity. But then beyond that, we get paid in tokens, and so we do have a pretty big token balance. After that, we try to manage, we try to limit our exposure to maybe 10 to 20% in tokens, just because, what Mike was saying, like, if you have all these tokens, but you don't, like, given the volatility, you need to be able to pay your expenses right, and so we try to limit that to 10 to 20%. Beyond that, you need to take into account, your clients, because a lot of times they're still active engagements. You can't be dumping their tokens and things like that. And so I'm sure we'll talk about this more later, but like DAO treasury management is also a different animal. And so there's a lot to think through there as well.
Yeah, let's talk about DAOs, because you have, we talked about this spectrum of different use cases, whether that's traditional enterprise. DAO is probably the far other end of that. How are they planning for this, where typically they'll have a bunch of ETH or maybe a native token of theirs? How are they thinking about the future and how to manage treasury going forward?
Yeah, so having your entire treasury in your native token presents a lot of problems. A lot of times when you need it the most, your token's probably tanking, right? And so that's actually why Gauntlet recently helped launch this protocol called ERA Finance. That's AERA. Basically, DAOs can then just deposit their funds or a portion of their funds into this vault that only the DAOs can withdraw from. And these vaults are managed decentralized, with decentralized portfolio managers that are incentivized to perform well, and they're penalized if they don't perform well. And so it just helps DAO treasury management. I don't know if anyone here has participated in DAO governance, but it's quite terrible, right? You like as a DAO, you're like, all right, so should we sell 25% of our tokens into like USDC? And then there's a 3-day, or a week debate about that. And then once you actually put the proposal up, there's another 3 days of voting. And then by then, like your token has moved away from you, ETH has moved away from you, and you're like, yeah, never mind. I don't want to do the trade anymore. And so it's just a mess to do DAO governance. And so ERA helps solve all of that.
Nice. Yeah, and one of the issues I've always encountered in this space is, setting that treasury plan with the fluctuating prices, with new assets coming on board. Jesse, you mentioned, what is your, I guess, ratio or allocation to digital assets? Mentioned like a 10 to 20% range. That's probably risen, I think, from the past, 3 or 5 years ago, when we were saying, maybe 5, 10% if you want to be aggressive. So glad to see those allocations going up. What are some of the other things that we should be considering as crypto companies? Maybe receiving some of our payments. At Bitwave, we just kind of did this plan of like, hey, how many of our payments are coming in crypto versus fiat? What do we want to hold on to? What do we want to, manage for the future? And how do we, eat our own dog food in a lot of ways to be able to enable some of these new products and features that we want to bring to market by kind of having this activity internally? So what are some of the other, maybe parameters of a treasury plan that you all think should be considered outside of allocation only?
For us, it comes down to cash flow efficiency as well. If you think about the traditional world, a lot of companies have access to so many different tools and assets. They have, venture financing, they have, debt financing, they have other types of access to different kind of credit capital, and they have various different ways to operationalize their cash flow management. Those things don't exist, in the world that at least we started to live in. So I think those are the things that we're looking forward to see more going forward, because we're seeing that these treasuries are becoming more mature. The management teams used to be just a few people holding a few keys, and now they have proper governance and proper board-like structures, and they think deeply about these deals, and like some of the governance discussions can take forever, but at least like they are deep, and the parties participating in that are basically understanding what they're dealing with. They're simulating different outcomes. It's just the toolkit is quite limited. So what they can do with the outcomes, it all comes down to which tools are available to them.
Can I address the issue of governance again, if that's cool? Again, like I came from traditional finance and have been in this space for a few years now, but we all talk about speed, and I think speed is all relative to the movement of the assets themselves. So like you were saying, like it just takes forever, and by that point the tokens have moved away from you, right? Which definitely true. But the speed at which DAO governance occurs relative to traditional institutions is like light years faster. Like there's some DAOs where the governance from the time you propose to the time there's a vote is like a week. And traditional finance, when you're trying to like meet with the board of a pension plan or whoever, those sales cycles are like 18 months, 24 months. So that implementation cycle is shrinking down dramatically in this space. I think the thing that distorts it for us is just what you said. It's that speed, the pace at which everything changes is so much faster. And we have to be like so acutely aware of that as we're having these conversations and as people are participating in DAO governance. It's a pretty wild thing.
Yeah, when you're building these tools, everything's moving, right? And so you have to build in that composability functionality that's going to, help with the next iteration, because by the time you launch the product, there's probably something new you need to add into it. And so, DAOs, I think, definitely accelerate that. Part of what you're building at Huma Herbal is this invoice factoring. Will you tell us a little bit about it? Because I think this is a really cool tool, and I'm very bullish on payments, in treasuries in 2023, and it's really fascinating to see a lot of this stuff come to life.
Yeah, we're super excited, obviously. So we call Huma income-backed DeFi for 99%. And when we started Huma, we realized that what exists in DeFi today, especially in the lending side, is quite primitive because, first of all, the assets you can use to borrow against are extremely limited, right? You need to have a lot of Ethereum, lots of wrapped BTC to participate to begin with. And good luck going to enterprise and saying, if you want to borrow in this world, you need to first find an OTC to convert some of your treasury into this Ethereum thing that is volatile. It's just a huge barrier basically. But if you look at the traditional finance, you realize a lot of the times the most reliable assets to finance against or to factor against are basically receivables. Right, receivables financing is a trillions of dollars of industry, and is recession-proof to a large extent when consumer financing, shrinks. The business financing that's backed by receivables is still quite strong and doesn't have as much of a exposure in terms of delinquencies when we have this kind of like macroeconomic events. And what if actually you enable every business in the world to bring their receivables on chain to borrow against? What if they didn't need to go through all those hops? All they had to do basically just tokenize the receivables and bring on chain and just borrow against it. So that's kind of like where we started from, and we built that protocol, and we're so happy to also have some of our early partners here request finance, so they integrate into Huma Finance. They are the largest Web3 invoicing platform, and now with this integration, anybody can go to request finance and say, I want to get paid now, I want to factor my invoices, and they can just do that instantly. Similarly, we have partners like ARF1. They are providing a USDC-based banking infrastructure for remittance companies. But the remittance companies can solve their instant settlement problem using that service. They still need to pre-fund the remittances to the receiving entity. What if you had an on-chain credit facility that used those basically payment orders that are tokenized on-chain as receivables and funded that instantly, right? You basically make remittances so much more efficient, both capital efficient and time efficient. We have partners like JXYZ, and they are providing small business loans in Philippines and Kenya, and they come from Tala, which is a large, micro lending solution. And they said, okay, why don't we actually give ownership to our borrowers? Every time they pay back successfully, why don't we reward them, and they can use those reward tokens to actually ensure their next borrowing, activity, and maybe borrow more or borrow at a better rate as well. So those things were not possible before these primitives were built, and we're so happy that actually we are able to enable all of these different use cases right now, especially for real-world businesses.
No, it's fascinating. I think in this world of kind of wonky banking crises and traditional loans being expensive and probably not even available to a lot of crypto companies, these are the kind of innovations that I think pop up in these market times. And it's also great because what does it do is incentivizes the enterprises in the space. Oh, if you want, to factor your invoices, you have to have invoices, you have to have revenue. And so it creates this really good, I think, jump start for enterprises to start thinking about that more of like, what is our treasury plan? How are we going to receive our revenue? What are we going to do with it and put it to work? And how do we grow from that instead of relying, solely on the venture capitalists, to be able to operate their business? So. Go ahead, Jesse.
I was going to say, another topic or, question that we need to be thinking about is also like custody, and, how trustworthy your, counterparties are. I think, crypto allows you to hold, your own keys and hold your own assets, but that becomes tricky too, right? And, traditionally you would think that your banking counterparty is pretty safe, but as we've learned over like the last month or so, that might not be the case, right? And so as a corporation or a DAO, you also need to be thinking about how do you hold your assets? Do we put it in multi-sig? Do we put it into this smart contract? Is this protocol safe and stuff like that? So that's another question that companies and DAOs need to be thinking about.
Yeah, and there are a lot more options, right? I remember, 5 years ago, the Treasury plan was, one guy walking around with the ledger, subject to the blunt object attack that could happen at any time at a conference. And there are all these options now where it's now, you have the multi-signature wallets to be able to manage, whether that's an Ethereum or an EVM ecosystem, or these MPC providers that are going across chains. What have you guys seen be some of the fastest adoption or options out there that people are using, people are implementing, and have been successful?
On our side, one thing we're super excited about is our partnership with Circle and what they're building as business wallets. So far, what we have seen as a big entrance problem to the ecosystem is basically like, how do I actually go from this fiat world that I've been living in to participate in DeFi or on-chain activities? And they had to figure out how to on-ramp, off-ramp, their token, and they had to figure out what that token should be. They had to set up a wallet with the right kind of governance. They need to learn what this MPC thing is. They need to learn what this multi-sig thing is. And I think with the business wallets product that's coming out from Circle, which we are design partner for, a lot of that complexity goes away. And companies will be able to manage their fiat/crypto treasury and directly participate in DeFi just using a regular contract activity connecting their business wallet. I think that's going to change a lot of things. I think it's going to make it much more accessible to a lot more enterprises around the world. So I'm super excited about that.
That's great. What tool, I guess, if you had to pick one, and maybe this kind of be the wrap-up question, but what tool are you excited about, everyone, that you want to see kind of come to life that's maybe not quite there yet? What do you want to see in the future?
Well, first of all, I do want to see what happens with the Benjis. I'm going to want to stack the Benjis, but yeah. Well, no, I'll let you get to that. But I think I'm pretty biased as well. With Era Finance, as I mentioned earlier, DAO Treasury management right now is difficult, right? It's a mess. It's also just like really hard to get everyone on the same page when you have that many stakeholders. And so being able to do that in also a decentralized manner, that's also, really safe. I think it's going to be pretty interesting. And so, right now we're taking, a few alpha customers. We're testing that right now, and we'll see how it goes. But pretty excited about Era.
I actually was going to say we're pretty excited about what we're working about this Benji thing, because I think the single biggest challenge digital assets face across every vertical and discipline and everything is adoption. Because as we get more adopters, we're going to have a lot more clarity and people will figure things out and stuff like that. And getting people from zero to something is a huge lift. And we've all had those discussions, whether it's with my parents, when I talked to them about it literally 2 days ago for a half hour in a car. And I was like, do you guys get it now? And they're like, no, we still don't get it. And so getting people off zero, and I'm not being a corporate shill when I mention Benji. The reason I bring it up is we had a conversation with, we have a VC client who referred someone to us who was not a Web3 native, and for Benji as a treasury solution. And we had this conversation with this guy, and he started off, he's like, look, I don't get blockchain at all. I don't understand the tech, and I'm not sure that I'm comfortable investing our treasury in technology I don't understand. I said, totally fair. Of course, like, I don't think that's a wise idea either. I think you need to educate yourself and really understand what's happening. And he was like, but just tell me about the product. And we were talking about it. Rick Golubov, who's my associate, is in the back corner. He and I were on the phone, and he was like, okay, so like, why would I buy this instead of a regular money fund? And I said, great question. You can own it in any form you want. We have this token, but you can also buy traditional shares. But the tokenized form has higher yield and lower fees than our other products. And he was like, I'm in. And so those types of people who, when they start to see the mass benefit and the cost reduction of this technology, I think that's when we'll start to have higher adoption rates. And so that's why stuff like this, where it's kind of acts as a bridge for people, is stuff that we're really excited about.
Not too much to add to that one, but when we talk about crypto, we talk about, programmable money. I think that's underselling for crypto. It's programmable financial primitives, and what can be done with that is almost infinite. Especially people coming from structured finance background understand that there are so many different ways to actually package products that creates basically differentiation to what's available to us, especially from the traditional finance. There's just like infinite space that we haven't even scratched the surface. What's happening today is probably just the beginning of it. I'm seeing also more people coming from structured finance, seeing this problem, seeing this gap, and trying to create this kind of like on-chain products that are just so much superior, not just from yield perspective, just like superior as a product. Yeah. And I'm just super excited to see, the tail end of it.
Awesome. Well, thank you all. It's been great. I'm super excited about the future of crypto treasury and DeFi and all that intersection. And I think there's a lot to come this year. So let's all keep in touch and keep watching what happens. Thank you.
Thank you.
Thank you.